Well, good morning, everyone. I hope everybody had an awesome weekend. This is Trading a Smaller Account, and today's webcast is brought to you by the number 3 because there are 3 trades we want to review, and then we want to place 3 bullish trades and 3 bearish trades. And I don't know if anyone else has noticed, but volatility seems to be on the grow or rising. And so we're going to look at a trading strategy today, 2 different types of trading strategies, because we're placing 3 bullish and 3 bearish trades that might take advantage of, an increasing rate of volatility, and how might we take advantage of that opportunity. So that's what we're going to focus on today. I appreciate all of you being here. We've got a lot of people here in the live webcast, and I want to thank each and every one of you for being here and for being so participatory in the chat. So to Rocky and Priya and Marcus and Tom and Janet and Jay and Marcus and Frank and the rest of the gang, thank you all for helping bring this class to life and bringing such great energy to it. I hope all of you are ready to participate because I've got a couple of questions for you throughout. Without further ado, we've got Kevin Horner with us in the chat. If you aren't following me on X, consider this your formal invitation to join Kevin and I in the land of X, Barb Armstrong CS and Kevin Horner CS. And just before we get into the thick of things this morning, keep in mind that options carry a high level of risk and aren't suitable for all investors. You have to apply for option trading privileges with Schwab, and not all will qualify. We're using the Paper Money software application on the Thinkorswim desktop platform. Try saying that 3 times fast. And it is a great place to learn, to make sure you're comfortable with how to use the platform, that you understand your trading strategy before you consider trading it in a live account. And know that there are some nuances and differences between Paper Money and a live account. The most important one, especially seeing as we're going to be looking at short verticals today, is that short options will never be assigned early in Paper Money. That can happen, and I've seen it happen with a short vertical trade. That can happen in a live account. So Kevin Horner does just a fantastic job 4 days a week in a show called Trader Talks at the Market Open, and does a really great market overview. So here, our market overview is very skinny. If you want the full meal deal, go and check that out. It will be available in the archives today's session. We're going to place, like, if the wind is at our back, 6 new trades, example trades today. And then we have 3 existing trades that I want to look at. Okay. And 1 trade that hit a target. Now, if you have never been to a live event, our first market drive of the year is in San Diego this Saturday. I will still be teaching this Friday, so I'm bringing everything for my setup. I'm going to fly in Thursday night so I can still teach this class on Friday. So no worries there. But if you have never been to a market drive and you're in the San Diego area or have a desire to go, it's free to attend, but you do need to register so we know like how many people we're providing coffee and breakfast for. And at this event, there's lunch, and there's even a really great reception at the end of the day. So we'll feed your mind and feed your body. And it kind of goes from, what's happening globally. And there's a lot of, global uncertainty right now. There's a lot going on in the world, and what impact that might be having on markets, right down to looking at individual stocks. So, and if you are there, please come up and introduce yourself. Both Kevin and I will be there, along with Ben Watson. And we're bringing people in from all over the country. So, be there, be square. And then the next 2 events are 2-day events in Denver and Dallas. Okay. Okie dokie. So there's my little commercial for that. So let's get out and have a look at the market. So let's start. And here's like the super quick overview. So the S&P 500, it's now, as of today, below the 10, below the 30, but it looks like this support level, and we might want to redraw this line a little. Oh, sorry. It's still basically holding this diagonal support level. But, Chicken Little, for some people, maybe in the barn doing warm-ups, but you might say, hey, you can relax there, chicken. We're still good here. But setting up, it's consolidating a little, right? How about the NASDAQ? Kind of more of the same, flirting with that diagonal support level. How about the Russell? Russell, you could argue that that's a break of support. Now, depending on how you draw your line, but if I draw it at the bottom of this, you might say, well, it's at a support level. And this is like where the art of technical analysis comes in, because you say tomato, I say tomato, but different people see different things. But basically at the bottom of this consolidating range that it's been in, and then when we look at the Dow, man, that's a big red candle today. So, but again, it's still, some would argue, a higher low than this low. And others would say, yeah, but it's a lower low than this low. But it's down 1.5% today. That's just a big fat red candle, right? Now let's look at the VIX, which is, going to inform our trading decisions today. And we're looking at, like, if we look at a 1-year chart, we've spent a lot of time below this 20 in the last year and not very much time above it, but we're peaking back above it again today. And so when we look at that, might we be able to take advantage of this rise in volatility? And so we're going to look at some short vertical trades, some short call verticals, and some short put verticals. Now, before we do that, and there's a couple of trades I want to look at. So one is AU. And when we come and we look at AU, we place 2 trades on Anglo Gold. This is a gold mining company, and they do mine for other things as well. But we saw this diagonal resistance breakout Friday, and we came in and we said, we're going to do a 1 ATR target. Now, someone asked a question of me in the comments over the weekend, and I hope you're listening. And they said, well, when we look at the volatility on this stock, it's very high. So that means these options are going to be relatively higher priced. And the question was, are you worried about volatility compression? No, because the volatility crush had already happened because earnings was Friday. The second thing is, the question was, well, why not do something like a long put vertical instead? And it's because we wanted to be in and out quickly. And if it did go up and hit our target, which it did today, and we are already out of the long call position, so we had minimal time decay. With a long call vertical, and if we come and look at VLO, which is the other one that somebody asked me to review, when you look at something like VLO, and when I looked at it first thing this morning, it was through both strikes, and it closed through both strikes on Friday. And I used to think when I first got started trading verticals that if it was through both strikes, then I'd have my max gain. And yet we were only up this morning about 10% on that, and we're probably down a little bit. Yeah, we're up 1.79% on this. And it's now below, well, it's trading in between the strikes, but we still have 3 weeks on this one. But that was the reason we chose the 1 ATR target on AU, because if it went up and hit the target, we're out. And we aren't necessarily out if it goes through both strikes. We also need, a time element, okay? And then we're still on, we're still in the stock trade. And for that, we set a Fibonacci target. If we had set a swing target, we would have been out of that one at the beginning of the day. Okay, so that's AU. And when we look at AU, so we placed these 2 trades on Friday. It hit our target this morning. We made $2.30. So again, our strategy this year was to try and make $200 a week. And we started with 25,000. We're almost at 31,000. I think we're up 23, 24% year to date. Now, the year is young yet. So we could end up, we could end up giving some of this profit back, and it's a paper money account. So we have to take that into account as well. But just to review for those of you who are new, and if you're new to this, please feel free to type a greeting into the chat so we can welcome you. So we made $2.30 or $230 because we did one contract. Why only one contract? Because that's all we could afford to do. Because when you buy a call, you could lose all of it. And we were risking $600 or $6 a share. And so our return on AU was 38%. And that's not bad for being in it for all of, one trading day. So that was that one. Okay. Yeah. So welcome to all the newbies. And this is how you calculate your gain on a long call and how you calculate your return on what you were risking. Okay. So that was AU. Now, the other one that I want to review, and for those of you who maybe missed the class, we placed 3 bullish trades on Boeing. And so we bought the stock and we placed a target. We did a long call vertical, which we're now underwater just a smidge. And we're underwater a little bit on the stock. And then the long call, we've lost 58%. Now, had this been a swing trade, we would have been out of it because our target is like we're out if we're down 50%. But I want to come and look at this and then just walk you through how a trader might look at this. So it looks to me, and it depends on how you draw your line. So if you say, well, I'm not counting the wicks, on Friday it was kind of looking hopeful in that we had this inverted hammer at a support level or around a support level. And today we're breaking down again. And you might say, well, if it breaks below this like 229-ish line, because support is a range, then I'm going to exit all 3 positions. I don't have to wait until I'm down 50% on the long call vertical to say this is not going according to plan and I'm out. And even though we have time in that we bought the stock, we have time for it to come around. If this doesn't hold, we don't have to wait until it hits our stop to exit. But on the long call, time is not our friend. This is a worrisome looking candle at a support level. I think on the long call, we exit, but I like to run a semi-democratic class. So we're going to do a poll. So, and I'm just going to say, do we exit the long call on Boeing? And I'll go with whatever the group decides. Okay, because it hasn't hit our exit yet. And our exit, so if we want to see where the exit is, we're going to come, we did the same exit on both the long call and the stock. Our exit is at 223.04. So I'll draw my line here just so you can see. And it was based on it being 3% below that support level. So 223.04. And when you have a long call with a target, kind of one of the mid-management rules is if it hasn't gone at least half the distance to the target in half the time you're expecting it to move, then exit the trade. Another rule might be if you have 2 down days in a row, exit the trade. And in that case, we should have exited the trade on this day. But on this day, we had this Harami candle and hammer candle, so we might have stayed in. But, that 2-day rule, 2 days and then a third down day, we should have been out. So we have 85% saying cut your losses. And this is something, if you're incorrect, the successful thing to do is take a small loss, because we could still lose another $163 on this, right? Right. Okay, so we're going to go in and exit that trade. And what I'm going to do is come to this call and I'm just going to cancel this order. And then when we come back down to this trade, we'll see that there is no exit in place, and we are going to right click and create a closing order, and we're going to cut bait on that. Now, I may not wait until Friday, so if tomorrow this continues to fall, we will exit the other two positions. Okay, so there's Boeing. And then the last one, and somebody asked me if I would talk about VLO today. So VLO, and it was up when I first looked at it this morning. So it's certainly been an uptrending stock. It's in the energy sector. And if we want to look at, you know, which sectors have been strongest over the last 3 months, hello, materials and energy, and then industrials. How about the last 4 weeks? Energy, number one. And so energy has been really strong. And this morning, this was actually up and it's now pulling back, but it's still, you know, not breaking below this support level. And so we had done a long call vertical and a stock trade on these. And this morning, when I first looked at them, they were both still up. Like now, you know, our short, that must be the long call vertical. And if I said something else, we had a long call vertical. We're down $5 on that. Our rule of thumb is we get out if it's down 50%. And so, you know, we're just kind of clipping along. And for the stock, you know, we're just down. We were up this morning. You know, we're just down a modest amount, but it hasn't broken a support level. So we're just going to let it percolate. The 2-day rule is if you place the bullish trade on a long call with a shorter term target, if it goes down 2 days in a row, then consider exiting the trade. Okay. Okay. How do we get the red barcode? Are you talking about this here, this year to date, month to date? That's a script and it's in the post pinned to the top of my X feed. I have a lot to cover today, so I'm not going to go and look that script up, but you just add the script by coming to setup, open shared item, pop that script in and import it, and bada bing, bada boom, you got it. Okay. Okay. So that's that. Now let's go to some new trades now. So I'm telling you that, you know, that Chicken Little needn't come out of the barn yet necessarily. But there are stocks that, even though the market has overall been uptrending, that haven't been playing along. And so that's why I thought it might be interesting to look at both the bullish and the bearish side of the tracks. So if we come and we look at Mickey D's, this is technically in the consumer discretionary sector. Some might consider it to be a staple. I don't know. I'm agnostic when it comes to, you know, Mickey D's, but this is a stock that is up 7% year to date. And we kind of have this like a double bottom type or, you know, broad cup and handle. It broke out, came up back to retest, came up, came down and established a new support level and is moving up today. But if we want to be, you know, what I call kind of sort of bullish, like could we maybe sell a put at 325? And then in order to define our risk, because selling a put says we're agreeing to buy the stock at 325 or obligating ourselves to buy the stock, then maybe sell the 320 underneath. And it's at 332. Like, could we even get enough premium? You know, and if we come out to March 20th, so we're 25 days out, we typically want to look in that 20 to 50 day range. So does it trade more than 1 million shares a day? If we go to our example trading plan, and I'll show you where to find that in a minute for the newbies, you know, yes, over 18 million. Then the next question is, are there at least 20 times the number of contracts that we want to trade? Well, at 325, we have 1,800 contracts. So yes, because we're going to do one. Do we have a tight bid-ask spread? Is it less than 10%? And this is 35 cents. So we're good to go there. So if I look at selling a vertical, and then the next thing is, and this is just a way of kind of establishing a rule of thumb. So I'm going to bring up a calculator and say, okay, if I take 81 minus 250. So 81 minus 250 is $1.69. And so kind of the third rule that we want to follow is divided by, I'm going to take the amount that I can make, which is $81. I'm going to divide it by how much I can lose, which is 250, the width of the spread, minus the $81. And then if I'm in this for 25 days, just as a rule of thumb, I want to get at least a 25% return on risk. And our potential return here is 47%, almost 48%. So that meets our requirements. And actually, I said we were going to do 1. What if we did 3? How much would we be risking? Well, we'd be risking $507. So we could sell 3 of these. Okay. And still be within, because we don't want to risk more than $500 on any one trade. And then in our example trading plan, we have a couple of other rules. One, we don't want to trade it over earnings. So if we come out, earnings is behind us, so we're good to go there. And then the second thing is we want to buy it back when we've got 80% of our max gain. So we're going to create an opposite order, and we're going to say, hey, when this is worth, about 12 cents, buy it back. And so what's the most we can make on this? $171. And in fact, we're saying, hey, if we can make about 150, we're going to be happy. Now, yeah, somebody brought up that we don't have a lot of volume on the 322.50. That's because it just became available to trade today. So we could do 2 things. One, we could widen out our spread. So we can come here and say, instead of 325, 322.50, we can make it 320. And we'll get $1.26. And if I take that and divide it by 374, that's a 33% return. So the potential return is less. Like, I just find it interesting, but if we want to honor that rule, that was kind of a good catch, but then we can only do 1 of these trades. Or you might say, well, I'm recognizing, like, just in the time we've been talking, another, 8 contracts have been traded. So people will start trading this. It's just because this just became available today. And so we're going to go ahead and stick with our original, because if this is 123 and this is 322.50, like, for it to be apples to apples, this should be 130. It should be 134. So even though we're paying a little more in commission, whoops. Okay, that went the wrong way. Sorry, I'm spending a lot of time on this one. So we're going to stick with our 3, but I like the way you're thinking, and that was a good question. So our first trigger sequence, we're going to right click anywhere on this line, opposite order, and buy it back. So 12, we'll make it 14 cents. Good till cancel, confirm and send. And we're going to put this in our short put vertical bucket. And if you're not familiar with this strategy, the idea here is that we're selling, and this is an intermediate level class. Oops. Oh, black. So we're selling this 325, and then we're buying the 322.50. And the goal with this is for it to stay above 325. So if it continues to go up, which is our expectation, we're happy campers and we have a successful trade. If it just goes sideways, and if at the end of 25 days, it's basically right where it was, we still have a successful trade. And we have $7 worth of wiggle room. So it can even come down a little bit and we're still okay. Where we get into trouble is if it goes below 325, but we have defined our risk. And one of our other rules is that we don't let this go to expiration. We close it out prior to expiration. So unless there's a technical hiccup, somebody's asking, when will this be posted to the archives? Typically within a couple of hours. Okay, so let's look at another example. Okay, so that was Mickey D's. Let's look at Apple. So, you know, they say an apple a day. So here we have, you know, a stock. Many of you are familiar with both Apple and its products, but, you know, it was kind of, we've got this diagonal support line. We had this bullish engulfing pattern on Friday. It's continuing to the upside. Could we just say, well, I could see maybe it continuing to use this as a support level. So could we come in and sell something maybe below, I don't know, this like 255? Ooh, could we get down that low? Like this is 256. Well, let's see, like, would there be enough premium for it to be worth it? So if I come out to March, again, 25 days, we've got a 10-cent bid-ask spread, 10,000 contracts. And you see, here's another one, this 250, 250. It just started trading today because this is a zero. Open interest is number of contracts when the market opened today. And it's already traded, you know, 29 contracts. You know, where we've got 20,000 and 10,000 here at the 260 and the 255. Oh, I wanted to do the 255, sorry. And then this 251 started trading today, this 250, 250, we already have 250 contracts traded. So we're gonna look at, I'm having trouble, it would seem, both talking and placing trades today. Okay, so we're looking at selling a vertical. So if we get 48 cents, and again, if we go to the 250, would we get 96? Now we'd only get 89. And so this is why sometimes the tighter. Now, what is one of the other detriments is that, you know, the probability of it going through, if it goes through the 255, of it going through the 252 also is a little higher. But if I'm looking at what's my potential return on risk, and this isn't as volatile a stock, it's a pretty, you know, it's closer to the steady Eddie category. So 49 divided by 201, that's about a 25% return on our risk, 24. So it just barely makes it. But if we're saying, okay, we could do 2 contracts because we don't want to risk more than 500. So 2 contracts, we're risking 404, you know, and we're just looking for a little win. Okay, little win. So right click, opposite order. Oops. You know, why did that go that way? Because I didn't come to advanced order and make it first trigger sequence. Now when I come up and right click and say create opposite order, it creates an exit. So we want to get out then when this is worth about 10 cents. Okay. And, you know, and some might say, well, I want a bigger return than that, you know, because that's a lot of wiggle room. This is trading at 267. So we have $12 worth of wiggle room. And so, you know, we could look at maybe the 260. So I'm going to go ahead and put this in. But if we come to the charts and we said, well, if I made it 260, what would that look like? Well, that's, you know, that's cutting it kind of close. So we might say, well, we're willing to take less than, and, you know, and make this 250. Or sorry, it was 255. And if we want to show, you know, our trade on the chart, 255, 250, expiration March 20th. And we're going to show that on the right. So now we can see what our goal is. We want it to stay above, and we've got lots of wiggle room. So yes, yeah, our max loss on this is what we were paid to get into the trade minus the spread. So our max loss is just over $400. Okay. Okay, so that's Caterpillar, that was Apple. The other bullish trade I was going to look at today, and it's certainly not the only bullish opportunity out there, but like Caterpillar has had this extraordinary run and it seems to be kind of consolidating. And we have this hammer, two hammers in a row, or a hammer, inverted hammer, and a doji. And, so could we do something below this 744 line? Could we maybe sell the 740? And maybe we can, and maybe we can't. And again, when we look, do we have enough contracts? Well, 21 versus 23. So that's about a $2 wide spread. So that's acceptable given our rules. Could we sell a vertical? And we don't have much, only one contract here. And I know it just started trading today, but we have 800 at the 730. So if we did 740, 730, that would meet our requirement. And that's a pretty juicy return because we're risking we can make 390 and we're risking, $6.10. So that's a pretty potentially big return. But the problem is, how much are we risking? We're risking 610 and we aren't willing to risk 610. And well, now our 740, we still have only one contract here, and so we can look at this, make it the 735. And some might say, well, because it just started trading today, I'm okay with that. And others might say, yeah, I'm not. And so, there isn't a wrong answer, but because we have the volume here, if we say, well, we're willing to go with that, it's a 257 credit on a $5 wide spread, which means we're risking 243 to potentially make 257. Now, we're not looking to make 257. We're saying, hey, if we can make 80% of that, we're going to be happy. So, and if we come and we take our 257, if you want to be official, I usually just kind of eyeball it in my head, times 0.2. So you say, when this is worth about 51 cents, well, now it's 222. So when it's worth about 44 cents, I'm going to buy it back. Good till canceled. And so if our max loss is 278, could we do two contracts? Well, we're just over 500. We could say yes, because our account, we are up. So now well, 590 is a little high. So if we say, yeah, 590, it shouldn't be 740, 735. No, we're only risking here 200 and change. Oh no, we're risking 300. Yep. We're only going to do one. Okay. So there's our bullish side of the tracks. Okay, now let's go over and flirt with the bears for a minute, okay? So we are, somebody said, Cat, our volume is less than 1 million. Our volume on Cat is 611,000 so far today, but we've just started trading today. Like, look at Friday. It was 2 million. Like, so the average is certainly over 1 million a day. Okay. And so that's what we're looking for. We're still pretty early in the day today. Okay. And so if you're wondering, you know, where do I come up with these ideas for rules? This is where I'll suggest that if you haven't subscribed to the Trader Talks channel from Schwab Coaching on YouTube, that you might want to do that. So not only is the playlist for this class in here, when you first get here, it'll show you what's currently being taught or what's coming up next. But if you come to playlists, I created a folder. And so if you scroll down, what you're looking for is the trade management mini series. And I've been talking about a lot of candlestick patterns. So if you're newer to technical analysis and looking at charts, I've created a bunch of like short mini sessions, each one looking at a different candle pattern. And so, you know, we talked about an inverted hammer and a hammer today. And so if you're newer to this, you're welcome to go watch those, you know, 5 minutes, 4 minutes, like they're all pretty short. But if you come down here, I did an example trading plan for short put verticals, and we've just done 3 example short put vertical trades. And we're now going to go and look at short call verticals. So if you want to see an example trading plan, it just covers that: what to buy, when to buy, how much to buy, when to exit, both if the trade goes for you or against you, and then what are your routines once you get into the trade. Okay, so this is just a handy resource for you that I have created. And you'll see that I'm going to add a couple of things to it. Another example trading plan. And then if you scroll to the very bottom, there's a bunch of how to set up a chart and that kind of stuff, things on Thinkorswim. So you're welcome to check those out also. All right, so let's come now and look at Microsoft. So Microsoft has been on the struggle bus. And, you know, it's been kind of downtrending, I'd say, officially since the end of October. And today we're seeing it break below this a support level. And so might this support level become a new ceiling? Well, we don't know yet, you know, and this is still a live candle, but that's a pretty big red candle. And, you know, it hung out here, like it's been playing kiss and tell with this as a support level around that 393, 394 range. Could we come up and sell something above that? You know, maybe at the 400 level. So up here around the 400, assuming with the, you know, expectation that it's going to stay below this level. And so if we come to the trade tab, we're now going to come over to the call side and say, okay, we've got 7,800 contracts, 4,000 contracts traded today. Could we sell a call? Now, we don't own the stock. So if we sell a call and we don't provide, you know, for the fact that we could be wrong, we've got unlimited risk. So, and again, if we have a 250 wide spread, we're getting 82 cents. What if we made it $5? Are we going to get $1.60? No, we're going to get $1.50. So you might say, yeah, but the odds of it going through both strikes. And if we come and we look at the volume on these, we've got more volume here. But these just started trading today, and it's already got 500 contracts and a 10-cent bid-ask spread. So if we're confident in the level we've sold, we might say, you know what, I'm just going to stick with that 402.50, and the extra that I will make will more than compensate for the difference in the transaction fees, because now we can place twice as many trades. And if we're looking at, okay, it's 80, 250 minus 80. So we're risking $2.50 per share. We're, you know, less our credit. So we're risking $1.70. That smells like pretty close to a 50% potential return. 82 divided by, well, 158. That's a potential 51% return. Now we're live in the market, so it's flipping all over the place. But if we say, okay, first trigger sequence, we can do 3 of these. first trigger sequence, right click, opposite order. When this is worth about 16 cents, buy it back. Now you might say, well, I want a 90% gain. Well, it's your trading plan. You can make it whatever you want. This is just the example trading plan we came up for this class, and we do not trade this over earnings because we're trying to trade it in a conservative way. That folder is called, with all the example trading plans, is called the Trade Management Mini Sessions. And I will put a link to that at the end of this webcast. If you go back and need to look for it, it will also be in the show notes down below. So this is a short call vertical, and I call it, it's kind of sort of bearish. So the most we can lose is 510. The most we can make is 240. And we're saying, hey, if we get like just over 200, we're going to be happy campers. Remember, the goal for this class was let's try and make 200 a week. Okay, so I've got 5 minutes left. So let's look at Netflix. So we might not get the third one in. So Netflix is like on this similar downward trajectory. I don't know why. I haven't canceled my membership with them yet. But, you know, if we're looking for an entry, and we call this a cablode, now this is still a live candle, but we're looking for a close below the low of the high day, and we have that. And yet it's still close to this old resistance, which appears to now be acting as, or old support, which now appears to be acting as resistance. So could we maybe sell an 80? You know, could we come up and sell an 80? You know, what does that look like on the chart? Could we come up here? Could we get enough premium? Maybe, maybe not. Like it's trading at 75.90. So it's giving us $4 worth of wiggle room. Well, let's see. I mean, we can check it out if it doesn't work. So we have 10,000 contracts traded today. So heavily traded stock, right? We have a 30% chance of it being in the money, which means we've got about a 70% chance of expiring worthless, a 4-cent bid-ask spread. It's traded 21 million shares today. So check, check, check. And so we're going to say, well, what's the last box to check? Are we getting enough juice for it to be worth the squeeze? So if we made this $2 wide, say maybe made it 80 and 82, even though we're probably not going to get 56 cents, we'd get 53. We said, okay, I'm getting 53 on a $2 wide spread. So 53 divided by 147. Oops. 53 divided by 147. That's about 36%. Is it more than 25? Yes, it is. So we're good to go. And if we're risking about 150, we could do 3 of these. Oops. Got a little trigger happy there. Create an opposite order. And our example plan is we get out when we've got about an 80% of our max gain. We want to take the risk off the table. So the most we can lose, 441, check. That's less than 500. Most we can make, 159. Got it. Okay, short to put a vertical. Okay, so the last one we were going to do today was Affirm. And I don't have time to go through this with you in class. So, you know, but again, it's been downtrending. Of late, it's been on the struggle bus. Today, we have this close below the low of the high day. You know, but what is the issue with a short call vertical here? Is that we'd want it to be up above 52 and we wouldn't likely get enough premium. So this might be one where you want to do something more directional, like either a long put vertical or, you know, what I had considered for this was doing a long put with a 1 ATR target. So we may save that for Friday and look at that again on Friday, but we covered a lot. So we reviewed AU, we reviewed VLO, and we reviewed and exited a position on BA. And thanks to everyone who voted on that. And then we placed bullish trades on McDonald's, Apple, and Caterpillar, and then bearish trades on Microsoft and Netflix. And all of these were short verticals. So I want to thank you for your participation. I want to thank, so a CBLOD stands for close below the low of the high day. It's CBLOD. Close below the low of the high day. So guys, if you haven't subscribed to the channel, please hit the subscribe button. It's free to join, and it's not free for 30 days and then there's a charge. It's free to join and it's free to continue being part of it. Follow us in the Land of X, Barb Armstrong CS and Kevin Horner CS. I'm also now on LinkedIn. If you want to come in and link up with me over there, consider this your invitation to do that. And then if you hit the like button, it's not only sounding like applause to me, as Cameron May likes to say, but it moves this up in the algorithms on YouTube so that more people can find this content. So thanks to Kevin and the guys behind the scenes for helping bring this class to life and for answering some of your questions. I really appreciate that. So get out there and hug someone you love, folks. Up next is Mr. James Boyd. So don't go anywhere. He'll be with you starting at the top of the hour. Take care, everyone. Have an awesome day.